How is the delta ratio calculated? If you are curious about how the delta ratio is calculated in options trading, you are in the right place. Understanding this concept can significantly impact your trading strategies. So, let's break it down. First, let's clarify what delta means in the context of options trading. Delta measures how much the price of an option is expected to change for every 1-point move in the price of the underlying asset. For instance, if a call option has a delta of 0.5, its price will move approximately 50 cents for every $1 move in the underlying stock. Now, the delta ratio itself is not a widely recognized term in options trading. However, in delta-neutral trading strategies, traders often refer to delta as a ratio to balance their portfolios. When traders mention calculating a delta ratio, they usually mean assessing how much delta exposure their portfolio has or how to adjust positions to achieve a desired delta. To calculate delta for an option, you can use the formula. Delta equals the change in the option's price divided by the change in the price of the underlying asset. This formula shows how sensitive the option is to movements in the underlying stock. In practice, traders utilize delta to manage risk and exposure. If you have a portfolio of options and aim to be delta neutral, meaning your portfolio's value does not change with small moves in the underlying stock, you would adjust your positions so the total delta is close to zero. This process is known as delta hedging. To find the delta ratio for a portfolio, you sum the deltas of all individual positions. For example, if you own 10 call options, each with a delta of 0.6, your total delta would be 6. If you want to reduce this exposure, you might sell shares of the underlying stock or buy put options that have a negative delta. Some traders also use the delta to theta ratio, which compares how much delta exposure you have to the amount of time decay in your portfolio. This comparison helps balance risk and reward, especially in strategies aiming for consistent returns over time. While delta ratio may not be a formal term, it generally refers to the total delta exposure of a portfolio or the relationship between delta and other Greeks like theta. Calculating delta involves using the formula mentioned earlier, and managing delta is central to advanced options strategies like delta-neutral trading. Traders adjust their positions to achieve specific delta targets, helping them control risk and exposure in their portfolios.